Okay, welcome everyone to a new episode of In the Driver's Seat with Steven Kohnke and myself, Simon Zryd. We're both certified value builders, certified exit planners, and are bringing a conversation to you that we're super passionate about, which is all about how do you build a more valuable and ultimately sellable business slash asset. We started this podcast beginning of 2024 this year, and I'll let Steven introduce the why behind our podcast.
Yeah, absolutely. This podcast is really meant to spread the message and help business owners understand what makes a business valuable. And the reason being we want to spread this message is the numbers that business owners are up against. It's 3 out of 4 businesses that go to sell, go to market, go to the open market, do not sell. And then that coupled with 70 to 90% of a business owner's wealth is tied up in that business. That's a huge gap, huge problem that we see. We're just trying to spread the word as best we can to as many people as we can and help people be more aware, help business owners be more aware of what makes a valuable asset, how they can actually cash in on all the hard work, blood, sweat, and tears that they put into their work over probably a very long time.
Yeah, and I think we both see that on a daily basis. It's like it's hard enough to maintain status quo for a lot of business owners, and it's not a conversation someone is in a lot. Is I'm thinking about selling my business. It's usually when they're already needing to sell or burned out or wanting to get out, and that's usually too late to make substantial changes in terms of valuation. Um, so in the last couple of episodes, we've talked primarily about the intangible
Mhm.
side of things when it comes to business valuations. We know that the value is determined between a number of seller discretionary earnings, EBITDA, some expression of profit,
Mhm.
and then a multiple. And the multiple is like this thing that's like, how does it really come to be, so to speak? And I think the last 2 episodes, one, we zoomed in on the structural capital, uh, processes, systems, and those kind of things. Then last week we talked about the human side of things, the human capital, the people you have in there and what they're bringing. And today we're going to zoom in a little bit on the customer side of your business, which is also in the Exit Planning Institute. We talk about it in terms of the customer capital.
Mhm.
So, Stephen, as a business owner, how do I wrap my head around what is customer capital?
Yeah.
How do I understand that?
It's to summarize, we'll start with the summary. It's how is the businesses, notice they say businesses, not the business owners, relationship with customers. So how does the company itself interact with their client base? This could be anywhere from brand. This could be uh, all the way to contracts or how revenue is being collected. It's everything that's customer facing and that relationship that's being built over time with the customer that you serve.
Mhm. So let's say I'm a business owner. I'm thinking of selling in 3 to 5 years.
Mhm.
And now I want to, like we often talked about, benchmark. Where am I
Mhm.
standing? What does best in class look like? Where am I
Mhm.
standing against that? And we can start with contracts. We can start with recurring revenue or dependency or concentration,
Mhm.
brand. Maybe let's start with brand,
Mhm.
because that's probably one of the hardest to even measure. But like, let's say I'm looking at my brand of my business. How do I know if I'm best in class or how to improve it or where I stand with that?
Yeah, the brand one is actually pretty tough because I think uh, obviously the longer you're in the marketplace, the more your brand will be recognized, assuming you have good marketing and that things that come along with a good brand are that like uh, the social proof, right? The longer a brand has been around, the longer the trust has been built, the better the social proof has, that shows a pretty good relationship with customers and potential customers to a potential buyer. So, the other part about brands, and this, I think this happens more in service style companies. I've a couple of our clients have made changes from having their name in the business to going maybe not necessarily generic, but actually having a more neutral uh,
Mhm.
title of their business, a more neutral what their business is called. So where that helps evaluation is, they don't have to do, or a potential buyer doesn't have to do a rebrand, or the seller doesn't have to look for someone with the exact same name,
Mhm.
which really shrinks that pool. But so that interaction of how long the brand has been around and then potentially how transferable that brand name is, I think does actually have an impact on valuation. How much that is, I think that really determines on what a buyer is looking for. But those are two ways to be looking at
Right.
brand, I see it.
Okay, and so I think it's probably obvious, but when you talk about social proof, a lot of it has to do with like online reviews,
Yeah,
listing, like those kind of things, right? What
exactly.
is
Yeah, yeah.
Facebook?
But what companies the brand has been working with? What are people saying about the company on different platforms? So that social proof component uh, really helps show a potential buyer what it would look like to continue on that journey. It helps with predictability. I think we've talked about it in net
Yeah,
promoter score in some ways too, but that's what
yeah,
the we're looking at.
because it's also like it's easier. Let's say you're taking over a chiropractic office, right? It's easier to take one over that has 200, 300 5-star reviews with a name that just helps with conversion right out of the gate versus you're starting out with 15 reviews and competing against someone with 300.
Yeah.
I think that's pretty obvious, and I do think also something that's a little bit overlooked, especially in certain industries, is the quality of the website. Like, what is your domain authority? How much organic traffic are you generating? Like those kind of metrics. It's like, what's your lead acquisition or customer acquisition cost, right? And that can make for a really attractive um, investment potentially if you have those things dialed in, or at least clearly know where you're standing, so that a potential buyer then can come in and say, oh, I can bring my own value to this, or I'm not good at this side, I need a company that is well established.
Mhm.
So doing a good job in representing where you're at in those regards, I guess. um,
Yeah.
so that's okay. So that makes sense on the branding side of things. Obviously, I would assume it would involve certain things like trademarks,
Mhm.
intellectual property, like that you're protected in terms of growth or future growth in that regard as well. On the
Yeah, yeah, how well you've protected that. That kind of breaches into structural capital a little bit, but it's the copyrights. If you have your brand copyrighted, your name, your company name, that certainly helps elevate the intangible component of the valuation. But that is very much customer facing that way too.
Mhm. And so we've talked already in one of our previous episodes a little bit around about the topic of customer concentration and
Mhm.
the risk that comes along with that. Is there more that we want to zoom in on through the lens of the customer capital conversation?
Yeah, I think the one thing to really pull out here is, I mentioned this most times I talk about this, is a business uh, acquirer wants to see a diverse customer base. They want to see revenue being generated from multiple sources. I'll call sources customers as well. So if a business is getting 30% of their overall revenue from one client, one customer source, that's pretty risky. And the number we usually look at is 15%. If you have if your largest customer represents under 15%, that's going to be a less risky business. So that from a diversification standpoint, that's probably the biggest thing to pull out on that side.
Okay, so as again, a business owner is looking to potentially sell, looking at customer concentration,
Mhm.
trying to stay under 15% with any of those
Yeah.
customers. Yeah.
I think what we're also looking at there, it's the predictability, right? The more predictable the future streams of revenues are, the higher the valuation is going to be. And um, if you have a more diverse customer base, meaning your revenue isn't being generated by one or two or three sources, it's going to have better predictability because the risk of losing a customer is way lower. So it's like, okay, it's a little negligible if we lose one and everyone's worth 1 or 2% of revenue. So it's just from a risk factor, having the diversification of customers is going to be important.
Hmm. You mentioned contracts as
Mhm.
well. Again, as a business owner looking at my existing client base and a buyer looking at future revenue streams, what can I look at, or what questions do I need to ask as a business owner when I'm looking at the the risks related with the contracts that I have with my customers?
Yeah, stronger the contracts, the better. From a predictability standpoint. But there's diminishing returns on that too, right? So customer capital is also customer satisfaction. And if you have lock-in multi-year contracts that are ironclad and there's no way getting that, like, your customer satisfaction is going to be much lower than if you have, a reoccurring contract that is easily manageable and the company is kind of held to a standard of holding on to that customer, that client. Um, so I mean, it kind of depends on who your buyer is going to be and what they care about. If you're a telephone company, right? They have all those ironclad long-term contracts versus, a consultancy maybe or a marketing agency. It all kind of depends on the type of industry that you're looking for. But generally speaking, if you have a recurring revenue stream, like that's part of your model. And the higher that recurring revenue stream, that relationship you have is an ongoing one with your customers, that's seen as more valuable. Because again, going back to the predictability of future revenue, that's going to be an important factor.
Mhm.
So I think we kind of touched on two things there, but yeah.
Yeah, I mean it's an interesting conversation because you we think about like a company like I mean any service provider, whether that's an IT or a bookkeeping firm, payroll,
Mhm.
you usually have contracts in place, and then they're kind of like evergreen contracts for a
Yeah.
certain, and with a certain cancellation, and is and some businesses grow at the pace where you have like this initial bunch of customers that are maybe your first round that
Mhm.
still operate on a handshake agreement kind of thing, or they might not have had the formal contracts in there. And so if I'm a couple of years out from selling, do I go as a business owner, how do I kind of like explore whether or not it's worth going back to securities contracts and have everyone sign the new agreements with a potential of maybe there's an upside potential of increasing fees and whatnot, but there's also the risk of you're introducing a conversation that you really don't want to introduce, because why put it on the table when nothing is wrong, kind of, and
Yeah.
either decide. So how do I think about that as an owner?
Yeah. I mean, if you're within a certain amount of years from an exit, uh, it's good to formalize those relationships. I mean, it's going to. I think that the benefits are going to outweigh the risks in that, because what you're doing is you're formalizing your business, you're stabilizing it, you're saying this is the way we do things, this is how we interact, and everyone's doing this. I think those earlier stages when you do have the handshakes, um, and looking to change it with a new buyer, with a new person at the helm, they're going to be a flight risk regardless, because chances are that that is a personal relationship,
Mhm.
and that the new buyer is going to be looking at that as, okay, we need to secure these contracts before we leave. That could go into the earnouts section.
Mhm.
If you are selling it, like this purchase price is it's it rests on your ability to secure those handshake agreement contracts for X period of time. Uh, because especially if we're talking about customer concentration, if they are a significant portion of revenue, that could be a big factor into the deal itself. Um, yeah,
Yeah. I mean,
that's
one of the things I've seen also is we're in the like a byproduct of updated contracts is legal protection. The terms might be the same, the monthly recurring retainer or fee might be the same, or the scope of work might be the same, but really updated language around, who's responsible for what.
yeah,
And I think that can really make an impact as well, even if you're not necessarily changing scope of work or anything.
yeah.
Um, yeah.
It, ultimately, we always come back to this. It's risk, right?
Yeah.
And having handshake agreements or not updated terms and terms on the agreements, it increases the risk. Ultimately, is what it comes down to. So that's going to be a devalued company, even if those handshake clients have been around for years. It's still going to be seen as a risk if it's not written down on paper the right way.
Yeah. What is your approach? And I know the answer is probably going to be somewhere in the ballpark of it depends, but sometimes there is like this opportunity to say, okay, we can improve our pricing, or we can improve our scope of work, or kind of like max out a certain relationship a little bit more, and that's going to show up on a maybe it's going to show up on a P&L and at least a forecast,
Mhm.
versus leaving things where they are at, and then positioning it as an opportunity for growth for a
Mhm.
buyer. How do I go about
Mhm.
that as a business owner, where I'm like, there's upsell potential there, versus you're trying to do all of that and trying to maximize your profit per account. I can
Yeah.
see, and I know I've been in conversations with clients around that. Like, how do you advise, or how do you approach that conversation?
Yeah, that's um that's a fun one. Yeah, because I think there's risks to being able to say, well, I guess not that. If we're using the future of the business, right? If we're saying, hey, there is potential for us to sell more to the customers that we already have, that could look really good for a potential buyer. Say, hey, we just haven't done it. This is where we see there is potential for growth into the future after the sale. We're not going to be the ones to do it, but that's something that you can look at in implementing. And here's the plan already. I've talked with clients about that, of saying, okay, well, we don't have to do it. We don't have to max this out right now. We can work that into the story. And I think that's where sort of the marketing and negotiation comes into actually talking to a buyer in that
Do,
way.
do you see it more on the side of it impacting the sellability as a whole versus actually the price point of the company, or where do you see that?
Yeah, it's see, that's a great question. I do think it depends in a way, because I think it can be seen as, well, you haven't maxed out the potential of this business, therefore I'm not going to give you as strong of a valuation for that. But they could also see it on the flip side as, say, I'm actually going to pay you a little bit higher than maybe what the market price shows you, because I see the potential of implementing
Mm-hmm.
XYZ into the business right away. So I think that's kind of why I'm like, I think it helps to position, and it helps with the story of of how you present the business, and as a benefit or a detractor to the business of, and if they want to put that work in too.
Yeah.
If there's someone who's like, yeah, I'm ready, let's go get my hands dirty and do it, or if there's someone who's looking for a business that's already there,
Yeah.
all
Yeah.
those things are already in place, or they are maxing out, they figured that out. So I think it really depends on who that owner is going to be, and how close you want to get to that. um, but
Yeah.
that's a little situational, but it's a good point.
I know. I mean, I see it like most business listings we see, right, have some form of so much untapped potential because you could make a flyer campaign and haven't done that in 3 years and acquire new customers, whatever. Like that's not what we're talking about here per se, but obviously that's what a buyer looks at is like, can I take this company and get it to a next level fairly
Yeah.
quickly or with a unique skill set that I can bring to the deal as an acquirer or with my resources. Yeah.
Yeah. Great.
Yeah. Okay, cool. So that's a little bit, I think in a different podcast, again, we already talked about, when to collect payment and the impact of that. I think that's maybe one thing that would fall into this conversation as
Mhm.
well in
Mhm.
terms of cash flow, making sure that we're collecting money as quickly as possible, as upfront as
Mhm.
possible, so we don't have a big cash gap that an owner needs to manage. But I think with that, anything else that we want to add to this conversation?
I think the biggest part to take away from here to remember it's the relationship, and if you have a strong relationship with customers, it shows great potential for growth into the future regardless of how it's set up. So treating your customers, treating your clients well, doing a good job, that's what really drives value when it comes to this intangible as I see it. You can manipulate all the different structural things behind the scenes and how you engage, but the satisfaction, the happiness, the results that you get, repeat customers, those are all very large indicators of the strength of your customer capital.
Yeah. And I think, you said it at the beginning, but I don't want to lose it because it's a nuance, but it's probably one of the most important one. It's like you meaning the business,
Yeah,
not you, the owner. If the
correct.
business had a good relationship with the customer, if the business provides good products and services and satisfaction versus don't take it as a business owners as I, Mrs. Jones, have to do that, but the business has to do that, I think.
Exactly. Yeah. Great call out.
Yeah. Okay, cool. So I think with that, we'll complete this episode. Again, thank you guys for tuning in and listening. If you have any comments, any of your own observations, experiences, we'd always love to hear from you. If you have any topics that you'd like us to cover as well, let us know. And until next week, thank
All
you.
right. Thanks, Simon.
Thank you, Stephen.